Welcome to this explainer. Today, we're unpacking what might just be the ultimate investment paradox surrounding SM Energy. They're a Texas-based independent oil and gas producer operating mostly out of the Permian, Maverick, and Uinta basins, and they recently overhauled their entire business through a massive merger with Civitas Resources. On paper, it sounds like the perfect setup, right? But as we're about to see, the numbers are telling us two completely different stories.
Just look at this first number, a price-to-earnings ratio of only 5.12x. To put that into perspective, that is practically a 60% discount compared to the rest of the industry. We're talking absolute bargain bin territory here.
And honestly, it gets even better. SM Energy is boasting an absolutely elite 87.2% gross margin. Why should you care? Well, in the wild, unpredictable energy sector, a margin that massive is practically a superpower. It means they can still turn a profit even if oil prices completely tank while their competitors are just burning through cash.
But hang on a second, here comes the whiplash. Guru Focus has actually slapped a severe, possible value trap warning right on this stock. They gave it a GF score of just 68 out of 100, and they're pointing to 5 to 9 distinct warning signals. When a platform like that explicitly yells value trap, we absolutely need to hit the brakes and pay attention.
So here's our roadmap for this explainer. We're going to cover the deep value paradox, break down the hidden red flags, explore the compelling green flags, put it through the ultimate guru test, tackle the moat debate, and finally deliver the final verdict.
Let's start with Section 1, the deep value paradox, elite metrics versus severe warnings.
Moving right along to Section 2, the hidden red flags, the bear case.
Now let's look at this. The sheer inconsistency in the return on invested capital, or ROIC, is just wild. Depending on exactly where you look, it ranges from a basically non-existent 0.1% from Money DJ all the way up to a jaw-dropping 178% from Tip Ranks. Seriously? If it's 0.1%, they have literally zero economic moat, but if it's 178%, they're practically the most profitable business on earth. Just the fact that this data is so wildly all over the place is a massive red flag all on its own.
Beyond that messy ROIC, we've got a terrifyingly low current ratio of just 0.6. Simply put, they owe more in short-term debt than they have in short-term assets. That's a liquidity crisis just waiting to happen. Add in a debt-to-equity ratio stretched out to 0.95, tons of analysts side-eye over their post-merger debt, and basically zero insider ownership. Oh, and their earnings are so cyclical that they actually lost money back in 2023. Remember, this is an industry that Zacks ranks in the bottom 13% globally, folks.
Okay, let's move to Section 3, compelling green flags, the bull case.
Let's yank that rope back over to the bulls. This company is historically cheap across the board. We're talking an EV to EBITDA of 4.02x, and it's trading below book value at 0.88x. Analysts are actually predicting a 34% upside, targeting around $38 a share. Plus, they're expecting transformative revenue growth in 2026, $375 million in captured merger synergies, 5 consecutive earnings beats, and a super low beta of 0.74, which really smooths out a lot of that market volatility. And the cherry on top? A solid 3% dividend yield, and a Graham number that implies well over 100% upside.
Which brings us to Section 4, the ultimate guru test, Graham, Lynch, and Buffett.
Let's put this thing through a real stress test, starting with the godfather of value investing himself, Benjamin Graham. Would SM Energy survive his strict defensive criteria?
Looking at his classic checklist, the valuation multiples are a total breeze. A PE of 5.12 and a PB of 0.88 are right in Graham's sweet spot. Their debt-to-equity of 0.95 barely squeaks by, but hey, it passes. But man, that current ratio of 0.6, massive fail. Graham demands a ratio above 2.0, so he knows for sure the company can pay its bills. Throw in those highly cyclical earnings and the whole foundation kind of starts to crumble.
If we were to simulate his verdict for this explainer, Graham would absolutely call this a paradox. He'd tell us to proceed with extreme caution because of those glaring liquidity and stability failures. You just can't ignore a business that might struggle to keep the lights on during an industry downturn. Next into the ring, let's see how SM Energy holds up against Peter Lynch and his famous growth at a reasonable price strategy.
Now, Lynch would be all over these valuation and growth metrics. A tiny PEG ratio of just 0.50 paired with a forecasted earnings growth of 27%, that is music to his ears. But there's a catch: unpredictability. The deeply cyclical nature of the energy sector, where earnings can literally evaporate the second oil prices drop, would be a massive stop sign for him.
So, his simulated verdict? Partial. He'd probably toss this stock right onto a watch list because that PEG ratio is just so juicy, but he wouldn't pull the trigger. Why? Because commodity businesses are notoriously tough to forecast. If you can't confidently predict next year's earnings, Lynch says walk away.
Finally, let's bring in the heavy hitter. How would the ultimate quality investor, Warren Buffett, view this energy play?
Buffett would absolutely love that elite 87.2% gross margin. It completely smashes his 40% minimum requirement. And he'd definitely appreciate the solid return on equity. But remember that absolutely chaotic ROIC data we looked at earlier? Combine that with the wildly unpredictable cyclical earnings and the complete lack of a true, durable economic moat, and you've got immediate deal breakers for the Oracle of Omaha.
So Buffett's simulated verdict ends up being another paradox. Ultimately, he'd pass entirely. His whole strategy hinges on absolute predictability and a rock-solid identifiable moat. SM Energy, unfortunately, just can't guarantee either of those in a market that is totally driven by commodities.
Which leads us perfectly into Section 5, the moat debate. Does it actually exist?
The battlefield here is perfectly balanced. On one side, SM Energy is undeniably a low-cost producer. Those massive gross margins, operating margins well over 83%, and their huge post-merger footprint in the Permian Basin, all of that creates a really strong cost moat. But flip the coin, and they have literally zero pricing power. Oil is a commodity, plain and simple. When you mix that complete lack of control with unstable ROIC and a bottom-tier industry ranking, you're left with a pretty weak 4 out of 10 moat rating. It's there, sure, but it is incredibly fragile.
And that brings us to Section 6, the final verdict. Brilliant margins, broken liquidity.
Let's put all the pieces of this puzzle together. We're looking at a top-tier operator with best-in-class margins, sitting at a historically cheap valuation right near its 52-week lows. But it is dragging around some truly terrifying liquidity risks. Yeah, I'm looking at you, 0.6 current ratio. And it's stuck in a highly cyclical commodity business. Sure, those $375 million in merger synergies are fantastic, but that guru-focused value trap warning is still blaring in the background. So, I'll leave you with this. When you balance these jaw-dropping metrics against the glaring structural alarms, is SM Energy a brilliant deep value opportunity, or is it just a value trap waiting to spring? Let that sink in and keep digging.